The sun has dipped below the horizon for many of us, casting long shadows across the path we once imagined our financial journey would take. Perhaps you stand at the threshold of your 40s, or perhaps you've already crossed it, feeling a subtle chill of regret, a whisper that time has slipped through your fingers like fine sand. You might look at the grand narratives of early investors, the tales of decades-long compounding, and feel a tightening in your chest, a quiet ache of what might have been, the fear of not having enough, of a retirement that feels more like a compromise than a culmination can settle deep in the bones, a heavy cloak woven from missed opportunities and the relentless march of years. This feeling is not an illusion. It is a real, raw truth in a world that often celebrates only the earliest beginnings. But what if the conventional wisdom of our time in the market, while true, isn't the entire truth? What if the secret to compounding wealth, particularly after 40, isn't solely about the number of candles on your cake, but about a deeper understanding, a more discerning eye, and a strategic application of principles that transcend mere chronology? Many believe that if you didn't begin investing in your 20s, the game is largely over, the potent magic of compounding forever out of reach. This narrative, while pervasive, obscures a profound truth. It leaves unexamined the potent levers available to those who come to the market with a clearer mind, a sharper focus, and the wisdom gained from life's own compounding lessons. Today, we journey beyond the superficial notion that youth is the sole prerequisite for substantial wealth accumulation. We will demystify the true engine of compounding, revealing how a focused, data-driven approach can accelerate your financial trajectory even when the clock feels like it's ticking faster. We will challenge the consensus that a late start condemns you to a modest finish. Instead, we will uncover the hidden truths behind wealth accumulation, showing how informed decision-making and a commitment to genuine value can transform your retirement prospects, allowing you to build sustainable wealth with purpose and precision. This is not about chasing fleeting trends or embracing reckless gambles. It is about embracing the enduring wisdom that allows even the late bloomer to cultivate a rich harvest. Many voices in the financial world whisper a comforting but often misleading counsel: diversify, diversify, diversify. For those who have reached their 40s and beyond, this conventional wisdom can become a silent trap, spreading your capital too thinly across countless holdings, diluting your conviction in the pursuit of broad exposure, often sabotages the very compounding you desperately seek. This approach frequently leads to investment inadequacy, where your portfolio merely tracks the market, unable to generate the accelerated growth needed to truly transform your retirement. Is your diversified portfolio truly diversified, or is it merely broad, lacking the focused conviction to genuinely move the needle? Benjamin Graham, the very foundation of value investing, spoke of the margin of safety as a protective moat around your capital. For the investor after 40, however, this principle transforms into a powerful lever for accelerated growth, not just protection. By rigorously analyzing intrinsic value and identifying significant discounts, you are actively positioning yourself to capitalize on the market's irrationality. This isn't about reckless risk, it's about informed, surgical precision, understanding that a deep discount offers substantial upside, compressing the time needed for meaningful wealth accumulation. Yet, a subtle adversary often holds us back: the status quo bias. It feels like prudence, a gentle hand guiding you towards broadly diversified funds, but beneath the surface, it often hides a fear of independent decision-making. This inertia keeps ambitious investors from seizing critical compounding opportunities, allowing others to profit from the emotional errors of Mr. Market. To overcome this, we must learn to identify robust economic moats, those sustainable competitive advantages that protect a company's profits. Picture a fortress with deep, unbreachable walls. Discovering these mature, often undervalued companies still offering asymmetric upside allows for focused capital allocation, transforming your approach from scattered exposure to surgical precision. Finally, the emotional weight of loss aversion can be particularly heavy for those after 40. The psychological trap of avoiding even small, temporary losses can prevent the pursuit of substantial gains, undermining the very compounding you seek. The fear of seeing a stock dip, even when the underlying fundamentals remain strong and the margin of safety is clear, can lead to premature selling or an unwillingness to invest in deeply undervalued assets. This emotional struggle, if left unaddressed, becomes a barrier to true financial independence. Are you truly making decisions based on data-driven truth, or are the whispers of fear guiding your hand? The market often moves not on logic, but on emotion, a swirling sea of collective sentiment. This herding bias draws investors together, often towards predictable mispricings. For the astute investor after 40, this collective irrationality isn't a frustration, it's a profound opportunity. While others chase the latest fad, driven by fear, you can stand apart, using data-driven insights to exploit these errors for accelerated gains. Understanding these emotional currents allows you to counter market noise and find genuine value where others only see a fleeting wave. Then Then there's the overconfidence bias, an error often masquerading as decisiveness. It looks like bold action, but beneath the surface, it often hides inadequate due diligence, a shortcut born from a desire to appear in control. This bias leads to chasing fads and market underperformance, sabotaging the ability to critically analyze financial data. True confidence stems not from bravado, but from meticulous research and a deep understanding of intrinsic value. Warren Buffett reminds us that investing is not a game where the highest IQ wins, but the one who is most rational. Consider the market's collective emotional cycles, the ebb and flow of fear and greed. These powerful currents generate irrational valuations, creating true behavioral arbitrage opportunities for the disciplined, data-driven investor. When fear grips the market, driving prices down on fundamentally sound companies, that is your moment to act. When greed inflates valuations, that is your moment for restraint. This is a symbolic exercise in emotional detachment, allowing you to harvest the fruits of others' emotional excesses. A practical technique involves identifying and capitalizing on anchoring bias and the availability heuristic. Anchoring occurs when initial information unduly influences decisions, while the availability heuristic makes us overestimate the likelihood of easily recalled events. In specific market sectors, these widespread emotional responses can be turned into your compounding advantage through contrarian analysis. By recognizing when the market is fixated on outdated news or overreacting, you can find undervalued gems. Finally, consider the subtle interplay of dopamine and cortisol in your investment decisions. Dopamine offers a quick reward for following trends, making it feel good to conform. Cortisol, on the other hand, is the mild stress of independent thought, the unease of standing alone, especially when feeling time pressure. These biochemical responses can hinder empowered decision-making, pushing you towards familiar but suboptimal paths. The challenge is to recognize these internal pressures and choose the path of deliberate, data-driven truth, even when it feels uncomfortable. What truths are your own emotions obscuring? The allure of passive income often paints a picture of effortless prosperity, a gentle stream of money flowing without continuous effort. For many investors, especially those after 40, this common distortion can be a blinding fog. It obscures the active management of capital truly required for accelerated growth and sustainable wealth accumulation. While passive investing has its place, relying solely on it for a late-stage wealth surge rarely delivers the concentrated returns needed to catch up. True compounding, the kind that transforms your retirement, demands a more engaged, discerning hand. There's a pervasive myth that market timing is impossible, a dogma often preached to dissuade investors from any form of active engagement. But for the late-stage investor, this isn't about precise daily predictions. It's about understanding cyclicality and tactical rebalancing. This is a form of active, data-driven capital allocation that, when executed with discipline, significantly enhances returns. Ray Dalio, with his deep understanding of economic cycles, illustrates how adapting to changing environments rather than blindly holding is crucial. Are you allowing this myth to keep you from engaging with the market's natural rhythms? There can be a philosophical wound in simply accepting market randomness without strategic engagement. It can lead to resignation, a quiet surrender to external forces, rather than cultivating a critical questioning mindset towards conventional buy and hold dogma for all circumstances. While long-term holding is foundational, uncritical adherence can mean missing opportunities for strategic reallocation when fundamental shifts occur. We must discern genuine underlying market mechanisms from superficial market noise. This involves a three-step technique. First, deeply understand the intrinsic value of your holdings. Second, monitor key macroeconomic signals. And third, disciplined reallocation, not based on emotion, but on these shifting values and signals. This moves beyond generic index tracking to a truly informed approach. Finally, consider how society has subtly distorted the image of the independent, data-driven investor. There's a push towards generic, set it and forget it strategies, presented as the only prudent path. This narrative, while comforting, may not serve the urgent, accelerated compounding goals of investors after 40. It often discourages the very critical thinking and deep analysis required to identify and capitalize on unique opportunities. The path to transforming your retirement, even with a late start, often involves challenging this consensus and finding your edge through a more active, thoughtful engagement with your capital. Do you dare to question the conventional path and forge your own? A silent fear often gnaws at the ambitious investor, the dread of financial loss stemming from opaque financial statements. You desire to truly understand a company's health beyond its reported figures, to overcome the distrust that arises when numbers don't quite add up. This isn't about suspicion for its own sake, but a deep-seated need for data-driven truth, especially when time is a precious commodity. Many believe that P/E ratios or analyst reports tell the whole story, a common distortion about valuation metrics. Yet, these figures often ignore crucial elements like off-balance sheet sheet liabilities, aggressive revenue recognition, or even hidden assets that can paint a vastly different picture. The expectation that conventional financial reports are fully transparent is often shattered upon closer inspection. Creative accounting can mask true performance or impending risks, a hidden truth frequently overlooked by mainstream analysis. This is why we must become financial detectives, seeking clarity where others see only complexity. Benjamin Graham taught us to read financial statements not as declarations, but as puzzles to be solved. We are uncovering the hidden truths behind wealth accumulation, and often those truths reside in the nooks and crannies of a balance sheet or income statement. For the investor after 40, this diligence is a practical transformation. You can conduct a mini forensic audit by focusing intently on a company's cash flow statement and its footnotes. The cash flow statement, less easily manipulated than the income statement, reveals the true flow of money in and out of a business. Footnotes, often dense and overlooked, frequently contain critical disclosures about debt, guarantees, or revenue recognition policies that can signal red flags or reveal overlooked value. This empowers you to make independent, informed investment decisions rather than relying on superficial headlines. The history of corporate malfeasance, though we need not name specific companies, reveals a profound lesson: the critical importance of independent, skeptical analysis. Relying solely on reported figures without questioning can be akin to trusting a map without verifying the terrain. Like a detective seeking truth in a complex case, the ambitious investor must dig deeper, connecting complex financial theory to practical, profitable application. This rigorous examination helps you identify genuinely undervalued assets amidst market hype, ensuring your capital works harder and smarter, accelerating your journey towards financial independence. Don't just invest, understand the why behind every decision. There's an unconscious limiting belief that often settles in after 40. The notion your investing journey must be confined to conservative, slow growth. This belief, while seemingly prudent, can prevent the exploration of intelligently structured asymmetric opportunities, those rare baits where potential gain vastly outweighs potential loss, accelerating wealth accumulation. It's a mental cage, keeping many from truly transforming their retirement. We must challenge the consensus that a late start means only modest returns. A common myth about risk versus return suggests that higher risk always equates to higher returns. This ignores the concept of favorable risk-reward ratios, or what Nassim Nicholas Taleb calls fat tails in investment outcomes, which can be strategically exploited. It's not about taking more risk, but smarter risk. Imagine a small, carefully placed seed that, if it sprouts, yields a magnificent tree, while if it fails, merely costs the seed itself. This is the essence of an asymmetric bet. We are uncovering the hidden truths behind wealth accumulation, and sometimes those truths reside in understanding risk differently. The cognitive bias of recency bias often leads investors to fear all risk, especially after a downturn. This can cause you to miss opportunities where potential upside vastly outweighs limited downside, hindering empowered decision-making. The memory of recent losses can be a powerful emotional anchor, but a master strategist knows that moments of market fear are often precisely when asymmetric baits present themselves. It's about having the courage to look beyond the immediate past and assess true long-term potential. To identify and structure these asymmetric baits, consider a three-step framework rooted in strategic finance and disciplined capital allocation. First, look for situations where a company's downside is protected by a strong balance sheet or tangible assets, creating a natural floor. Second, identify catalysts that could unlock significant value, often overlooked by the broader market. Third, size your position so that even if the bet doesn't pay off, the loss is manageable, but if it does, the impact is substantial. This is about surgical precision, not reckless abandon. Finally, consider the mental healing model based on Daniel Kahneman's asterisk thinking, fast and slow asterisk. Understanding our intuitive biases towards risk, our fast, emotional responses can allow for more rational, strategic decisions for accelerated compounding. By consciously engaging our slow, deliberate thinking, we can overcome the fear that often paralyzes us. This journey is akin to becoming a master strategist, one who understands the terrain of the market and the landscape of their own mind. What calculated risks are you willing to consider to truly transform your financial future? We have journeyed through the intricate landscape of financial wisdom, uncovering that a late start after 40 is not a sentence to mediocrity, but a profound invitation to strategic mastery. The fear that once tightened your chest, the quiet ache of missed time, can now begin to ease. We've seen how over-diversification can dilute your true potential, how understanding behavioral biases transforms market noise into opportunity, and how active, data-driven capital allocation transcends the passive trap. We have peered beneath the surface of financial statements, seeking hidden truths, and learned to structure asymmetric baits where potential gain gains far outstrip potential losses. This is the essence of transforming perceived limitations into powerful strategic advantages, leading to sustainable wealth accumulation. Warren Buffett, a beacon of clarity in complex markets, often reminds us that true wealth accumulation is less about the sheer amount of time in the market and infinitely more about the quality of informed, disciplined decision-making. It is not the number of years you invest, but the wisdom and conviction you bring to each investment that truly compounds. For those of us who come to this path later, we carry the invaluable weight of life experience, a seasoned skepticism towards superficial narratives, and a sharpened hunger for genuine insight. This is not a handicap, it is your unseen edge. Now is the moment to embrace your inner skeptical analyst. Let the principles of intrinsic value guide your hand, allowing behavioral insights to illuminate the market's irrationalities. Apply strategic capital allocation with the precision of a master craftsman, shaping your unique financial journey with purpose. Move beyond the anxiety of feeling inadequate, beyond the frustration of conflicting information. This path is one of continuous learning, of independent thought, leading you towards empowered financial mastery and confident navigation of these complex markets. Imagine yourself standing at the helm of a vessel, not adrift in the vast ocean, but charting a course with a finely tuned compass, guided by stars and deep knowledge of the currents. Each piece of data, each insight into human behavior is a star in your sky, illuminating your path. Take a moment now, close your eyes and picture a single, robust tree you wish to cultivate in your financial garden. See its strong roots, its resilient trunk. What single, data-driven truth will you commit to nurturing in its soil this week? In this quiet space of reflection, what deeply held financial belief are you now willing to challenge, armed with the wisdom we have explored today?